The fact of the matter is that it's going to be very hard for governments to go back to a gold standard, even if they want to. It's going to take a huge financial reset, a loss of all trust for the for politicians to even consider this. It's going to be a whole new era of politics. These are not going to be the same regular faces that you know. If this happens, if financial reset happens, it's the birth of a new power structure in the world. It's everything.
Hi, and welcome to the X22 Report Spotlight. Today we have a returning guest, Lior Gantz. Lior runs numerous successful businesses and has traveled to over 30 countries in the past decade. He is an entrepreneur and investor. He's the founder of Wealth Research Group. That's wealthresearchgroup.com. And I am very happy to have Lior back on the X22 Report Spotlight. Lior, welcome back to the Spotlight.
Thanks for having me, Dave.
Hey, thanks for being here. And let's start off with what the mainstream media is saying about the economy. Now, a lot of the mainstream media financial channels are talking about a recession that's coming in 2019, 2020. I mean, during Christmas, right before Christmas, the market came down, and then Trump came out and said, listen, companies are doing great. I would suggest everyone buying the dip. And all of a sudden, the market went up 1,000 points a day after Christmas. I mean, it just seems like things are just absolutely crazy. Do you think that we are headed into a recession?
Well, we are definitely heading into a recession, but the timeline is not necessarily going to be 2019. So, in 2018, you saw a huge repricing of equities. So in 2017, everything went up. Not only stocks, but you had the cryptocurrency mania. There was a lot of optimism. This was right off the backs of Trump getting elected. Optimism was really high. Tax cuts were being discussed. Everything was going up every single month. The S&P 500 went up in 2017. There is no other year in history since 1957, when the S&P 500 was incepted, that this has happened. Very low volatility, and then you had the speculative money going into cryptocurrencies. It used to go into the NASDAQ, right? And it did go into FANG stocks, but it went even further into a very speculative sector like cryptocurrencies. And you saw 2017, this huge run and rally in all of the most tech-dominated sectors. And this is very akin to late cycle action. And then in 2018, right off the bat, right when it started, you started seeing the repricing, that investors understood that we're moving from this economy that has a very full capacity, low unemployment, and tamed inflation rates into an economy that has the potential to go and overheat. And this is very typical of late cycle business cycles, right? 7 to 10 years, where things go up from high unemployment to low unemployment, from very weak to very strong. And this is what we saw in the early parts of 2018. You then saw a little bit of calm, especially in the markets, but cryptocurrencies kept going down, just kept running, going down. Speculative mania was over for them. And by Q4 of 2018, you saw the speculative mania in FANGs and all the usual suspects also crashing down hard. This December was the worst December for the S&P 500 since inception. All the three major indices went into bear market territory, so below 20% from the peaks. And on the flip side, from its lows in August at 1176, gold ounces are up about 9%, and silver, since its bottom at 1395 in mid-November, is up about 12%. So very inversely correlated, the stock markets and precious metals. Now this rotation between tech and commodities usually happens in late cycles, when the markets are convinced that inflation will keep heading higher, and the Fed will not have a lot of tools to keep raising rates at the same time. So when that happens, we know that investors just do not like stocks when there's high inflation, because margins go down, they have to pay higher wages, and obviously they need to think about how they manage their capital expenditures. All of this is very bad for growth. And then you couple this with what's going on with China, that is not resolved yet, and what's going on in Europe with obviously with Brexit and everything else that's going on in France and the Yellow Vest. This is all playing out to be very detrimental, and investors are simply repricing how much they're willing to pay for stocks, how much they're willing to pay for bonds, and how much they are willing to pay for an insurance premium, which is obviously precious metals and cash. So that's where we're at right now.
Do you think that, I mean, there's many people out there saying that the market's going to come down like 50%. I mean, do you see that happening?
Well, here's the thing. Think about what the stock markets have already done in the past 3 months. They've gone down from all-time highs into bear market territory in 3 months. So that's a very massive move. In terms of profit guidance and how companies are estimating their 2019s, it's not as good as 2018 with all the tax cuts that were there. You saw record margins and record profits for the S&P 500, the Dow, and the NASDAQ. So it's definitely not going to be the same. But there is no reason to believe that investors will look for much lower prices before there actually is a bid for stocks out there. Remember the options, David. That's very important to understand always with investments. The bond yields, even investment grade, even corporate, and obviously the treasury bonds, they're right at par with core inflation, with core CPI numbers. So the core CPI, the official number, is 2.1%, and then for a 10-year bond, you're getting about 2.4%. So you're loaning the government money, the U.S. government, for 10 years. So until 2029, you're going to get coupon payments, and you're just going to be above inflation. So you're just going to make about 0.3 in real rates on your coupon. That is not attractive at all. But look at stocks on the flip side. After 10 years of going up, the multiples are already very high. So in terms of the total returns, so dividends plus appreciation, you can't expect the S&P 500 to keep doing what it did for the past 10 years. It just won't. So you're looking at a situation where stocks will probably net around 4 to 5% for the next 5-6 years. So you're looking at a chance of making about 4 to 5% with very high risk stocks, or making nothing with bonds, and both are not attractive. Now, on the flip side, if you get any sort of a deal with China that creates borders and does away with pure globalism, you're going to see prices for everyday stuff rise, because when you make choices and options and decisions that are not purely based on economic principles alone, so the best price, because that's what American corporations have done. They basically said, we don't care about our employees, we don't care about the middle class, we don't care about the American domestic economy. We go wherever the price is best and the quality meets our standards. So a company like Nike, it doesn't think, oh my God, I have to open a manufacturing base in one of our more distressed states. No, it thinks, how can I open another manufacturing base in Bangladesh or in Cambodia, because I need to get the best price for my cotton goods. And what President Trump and this administration is trying to do is level the playing field so that there are some laws and regulations and rules in place to make sure that half of America doesn't continue to earn $30,000 pre-tax a year, because there is no middle class when 75 million out of 150 million people that are employed make 30 grand a year in a society that the cost of living in America, if everyone was paying taxes, would be $48,000 a year. So if there's no deficit and the economy is running on the tax receipts alone, every person would need to pay $48,000 in taxes. For that to happen, you can't have an economy that half of the people make 30 grand a year. So there obviously is a huge, huge problem. That's why there's the national debt just keeps rising, and there's $1 trillion deficits every year, because about 15 million people, which is 10% of the working population, makes minimum wage. Now, after 10 years, right now, Dave, minimum wage in 20 states is going to be risen this year to about $12 to $15 per hour. So you're going to see a lot of companies paying more in wages. Just Amazon is paying $3 million more per hour for increasing their wages to $15 per hour. So that's $24 billion a year in wage increases. That's a lot of money that's going to go into the economy. And that's why there's a lot of inflation baked in the cake for 2019, and why precious metals are really rallying right now, and why stocks are not. So for stocks to have this relief, this tension relief, it might take a while, and it will take some sort of a resolution in a long-term agreement with China. So that's the big thing that's on the table.
You mentioned Trump, making it an even playing field, trying to bring the companies back to the United States and, bring back manufacturing. He continually says this. Do you think it is possible to bring back the amount of manufacturing and the companies that moved out of the United States back to the United States if he does get rid of regulations and gives them tax benefits? You think these companies would come back?
All of these companies that have manufacturing bases outside of the U.S. and they're basically engaged in things that can be done much, much cheaper outside and don't involve a lot of brain power, that's going to stay outside. All the IP is already there, the intellectual property. People over there know how to run these factories, and what the U.S. will continue to engage in and continue to excel at is technology and intelligence, and anything that has to do with the army and defense. That's where the United States can truly excel, because it has very good education system compared to other countries, and it has a lot of tech hubs and financial centers. So that's where the United States future lies. But that future sacrifices an enormous amount of the population. And that's why we wrote about both of these things, the wealth gap and the wealth disparity going forward, and it's not going to get corrected, Dave. There's no revival to the middle class. If you go to wealthresearchgroup.com/attack and /drama, we lay out the case that there will be no middle class in America by 2022. You will either be part of the wealthier class or you will be part of the struggling class. And there's literally no way to change that. The only thing you can do is moderate the effects of it and basically rebuild and reorganize America to be equipped to be competitive for the 21st century. So, and that's what the Trump administration is trying to do. But there is friction to this, right? When you reorganize an entire country that was living inside of this illusion, this dream, they can continue to just issue debt and pay for anything that they want. De-Dollarization has basically burst that bubble. 40%, Dave, 40% of the United States deficit, or the entire budget, is funded by foreign countries. Every time a U.S. Army ignites the tank, the fuel, 40% of it is funded by China, by Japan, by Russia, by other countries. By Germany, by France. It's insane. Every time you pay out Medicare or Medicaid or Social Security or income security or anything that the federal government pays out, 40% of it is funded by people in other countries. That's very unique to the United States alone. So when you see Japan and China and Russia starting to accelerate the de-dollarization, going out of holding a lot of treasury debt, that is a problem for a country that cannot stop what it's doing right now. You cannot stop Medicare, Medicaid, and Social Security that easily. You just cannot stop these entitlement programs without creating social unrest. And so as the economy, like you say, is rolling into a recession in 2020, and capital gains tax from the stock market is going to go down, and corporate tax is going to go down, these trillion-dollar deficits will need to get monetized by some, in some fashion. And that is why not only do I think that the United States will start printing currency, but also Ray Dalio, the world's largest hedge fund manager, is thinking that the U.S. index is going down by about 25 to 30% in the next 5 years. And that's massive, because it stands at about 96, 97 as we're doing this interview. If it goes down by 25%, it goes down to its all-time low at 75. So that's very, very low. It's a huge dollar bear market. It's going to affect, obviously, commodities worldwide, which are going to go up in price. It's going to make the world more expensive. And whenever every country wants to do stuff on their own, become self-sufficient instead of having open borders, that's a recipe for stagflation. That's a recipe for higher prices. So as we're doing this reorganization for the United States, one of the unintended consequences is higher prices, higher cost of living. And you're going to have that. There's just no avoiding it. So it's definitely important to keep that in mind. If you go to wealthresearchgroup.com/top, you can actually see a wide array of special reports that have to do with this, with how to prepare for a crash, what I'm doing with my own portfolio. You can even go to wealthresearchgroup.com/portfolio and even download my own portfolio for the coming year. And we're going to update that special report real soon to meet this new reality of 2019. But yields are inverting, as trending lower. They're becoming inverted. The 1 to 2 year is already inverted. The 2 to 5 is already inverted. The one that people need to really watch, that has created a recession to follow every time. 17 times out of 17, 17 out of 17. Every time the 2 year and the 10 year invert, there's a recession between 12 to 18 months after that. And we're just shy of getting an inversion with the 2 year to 10 year. So since 1913, every time that the Fed has tightened monetary policy in order to combat an overheating economy and in order to combat rising inflation rates, every time they've mismanaged that, and the 2 year eclipses the yield of the 10 year, every time that has happened, there's been a recession. Every time there's been a recession in the United States, there's been a market crash. So that's the natural recipe and the natural chain of events for this economy. And therefore, that's why I'm saying people are saying 50% drop in stocks. We haven't hit the recession yet. When we hit the recession, it will be time to explore such a dramatic fall in stocks. But I wouldn't say no to that at all. In fact, Warren Buffett and Charlie Munger both have said recently that this might happen, a 50% drop in stocks. And these people are very optimistic about the U.S. economy throughout their very long lives, and they've seen everything from world wars to the Nixon shock to 1987 to the dot-com bust. So they know to the 2008 Great Recession. If they say that you need to prepare for a 50% drop in equity prices, then that's very real.
Now, what happens to gold? Because last time the market came down, this was 2008, 2009, we saw gold after that shoot up to, 1,400, 1,500, and it kept moving up. This time, do you think the same thing is going to happen? Because now we have a lot more debt, because back then, the amount of debt we had was about 10 trillion. Now we have over 21 trillion. The worldwide debt is, hundreds of trillion. This time, it might be a little bit different. Do you think gold will shoot up at that time when, everything starts to fall apart?
Gold and silver both. So you've just went through a period, a 10-year period, well, basically an 8-year period since 2011, since gold peaked at about 1900 and silver peaked at around 49, where they went down until the end of 2015. Both of them have went down about 40 to 50, 60%, and then bottomed around December 2015. Gold at 1153, and it's now about 1280 as we're doing this interview, even 1290. So it's definitely inside of this little bull market, very moderate bull market. It's just up about 20%. But this is not a raging bull market, especially for silver that has not followed gold. Now, the reason that silver, which is more industrial in price, has not followed gold is very tied to monetary and geopolitical events, inflation. Jewelry makes a very small part of how the price of gold gets determined. It's mostly investment demand. So whenever people are willing to pay more for a premium, basically, they'll pay more for gold because there is no shortage of gold, right? All the gold that has ever existed is above ground. It's a very unique commodity, a very unique mineral. It simply has natural characteristics from Mother Nature that allows it to be the best form of money. Silver has had the same characteristics. They're innate, so you can't change the characteristics of silver. They're phenomenal for being used as a monetary metal. But in the 20th century, it's also been found that it's great for industrial purposes. So since industrial purposes make up the majority of the consumption since 1971, you're seeing silver always tied to the production cost, give or take a few dollars above the production cost. Now, if you wanted to have a premium like it did in 2011 or whenever it rallies hard, like in the 70s, there needs to be a lot of investment demand for it. And there simply hasn't been from 2011 until now. If you call dealers, they tell you it's worse every year. And the reason is because people have lost the interest in silver as a protection, and people in general. Obviously, there are people that buy silver all the time and use the fact that the price is going down. But really, since the Trump election, the middle class has put their faith into the government much more than before, and people have basically not been buying a lot of silver, and they have been buying cryptocurrencies even instead. Now, in 2019, there's really no avoiding the fact that silver will trade much above its mining cost. The reason is that investment demand is picking up, and the real reason for why investment demand is picking up is because, one, real interest rates. So basically, the 10-year Treasury minus core inflation is getting back into negative territory with 2.4% on the 10-year bond and 2.1% for the official core inflation, and trending higher. You're going to see negative real rates, which happened in 2016, the last time the gold really took off. And obviously gold stocks really took off. So the same events are shaping up this time around as well. Add to that, the US dollar, Dave, was the best performing asset of 2018. The last time that has happened was 1969, 2 years before the Nixon shock. So in other words, whenever the dollar is the best performing currency not the best performing currency, the best performing asset on the planet. In other words, if all hedge fund managers on January 1st would have closed shop and went to Thailand for a 1-year vacation and came back on January 1st, 2019, they would be better off and their clients would be better off than what they did this year. 93% of asset classes have been negative in 2018, have performed negatively. So whenever you see a situation like that, it happened last time in 1969, it really is the early innings of a huge bear market for the dollar. And that's important to understand. So that's the second thing. And then you got the third thing, which is that the stock market isn't producing these great results as it did in the past 10 years. So all the three major catalysts for a huge boom in precious metals are there. You got a shaky economy, a very lots of tension geopolitically, the inflation rising, and therefore stocks are not doing that well, and negative real interest rates are coming back. And with 20 states raising their minimum wages, you're going to see a lot of money velocity, a lot of inflation baked into the cake, and it could be a phenomenal year. In fact, yesterday on January 2nd, we alerted our number one gold stock for 2019, and it shot up 43% on a huge one-day event. It was the best performing stock in all stock markets, all exchanges around the world for yesterday. And that's because people in 2018 have discarded gold investments, gold stocks, etc. And now they're starting to understand the value of what these companies have in the ground, because exploration has been so bad for 10 years. There's literally no discoveries of new gold deposits, and you're going to see production about half by 2024. So that's a huge deal. And you can if you go to wealthresearchgroup.com/bear, and I think I talked about this the last time we were here, that's 11 bear market strategies that I've used during the gold bear years in order to prepare for this. And I got a lot of emails from people who downloaded it, and it really helped them to prepare. So that's I think that is very beneficial.
So with all this going on, I mean, we have Trump, who has been contradicting the Fed, continually saying, listen, I don't want you raising rates. I don't want you raising rates. And the Fed is raising rates. And while this is going on, we know that China, Russia, and many other countries, they're either accumulating gold, repatriating their gold. And QAnon has said that gold will bring down the Fed. Now, if gold starts to rise, and everything starts to fall apart, the stock market, the global economy starts to slow, and it affects all these different areas. Don't you think China, Russia, the United States, if gold is rising at this time, won't the central banks have a problem on their hand? Because if gold, let's say, goes to 1900, then to 2000, what does that say about their currency?
We're a long ways from 1900 to 2000, so it's a huge move. But in general, if you keep seeing gold going up and silver going up, that's important to see both of them going up together, and silver even outperforming gold to confirm a renewed bull market. Like I told you off the air, I think that monetary policy is going to play less of a role in the coming decade than fiscal policy. The tools that the Federal Reserve has, or any central bank, with QE programs or whatever they call it, bond purchases, etc., when they increase their balance sheet in order to absorb assets at artificially high prices to prop up the economy, they already done that. It's done. They're shrinking their balance sheet now, and they're definitely not going to embark on a major campaign again like this, because half of Americans already feel like the central bank is working for the elite. They just cannot, politically justify doing this again. They can't lower interest rates that much anymore, right? It's the Fed's fund rate is already playing with inflation rate as it is. If they cut rates again substantially, it's going to fuel an insane bubble. And so monetary policy is going to get marginalized. And you're already seeing, President Trump all over the Fed, right? Telling them what he thinks about them, telling them how he criticizes their manners. They're going to try and marginalize themselves and put themselves in a little corner and not be the center stage like they have been for the past 10 years. What you're going to see more is fiscal policy. You're going to see, like you're seeing right now, you're going to see tax cuts, new trade deals, new regulations. Obviously, you're going to see a lot of talk about how to restructure the unfunded liabilities. This is going to be the theme for the next decade. And that's a very inflationary theme. When you have governments doing fiscal policy, they're going to spend on infrastructure. They're going to try and put people to work. And all of that is, it's very good domestically for each country to strengthen their own economy. But it's also going to create a situation where prices rise in a very noticeable fashion. So if you take a loaf of bread that's priced for about $1.50, the wheat component of it is about 7 cents. So even if wheat prices go up, even if they double, it's not going to affect the end price or the retail price of a loaf of bread. What really impacts all of the everyday items that we use, all the services that we use, is the supply chain in terms of the wages that people receive. So if you have a situation where the citizenry really wants to see higher minimum wages, more regulations to make sure that they have jobs, that is really inflationary. That's what I'm telling you is going on in 2019. 20 states are raising their obligatory minimum wage after 1 decade of stagnant wages. So whenever wages go up, everyday items, they just simply go up because all costs are going to get transferred to the consumer. If you can imagine, Kimberly-Clark has thousands and thousands of employees, Walmart, all of these companies, in order to make sure that their margins stay, fat, they need to pass on these increases in wages to the consumer. And that's exactly what they're going to do. So do I necessarily see gold going up to 1900 or 2000? We're not there yet. Let's not create this tunnel vision for it. But even if it goes up 20 to 30% from now, that says a lot about how weak fiat currencies are around the world. And you saw in 2018, you saw hyperinflations in several countries. So the U.S. economy is one of the only, the United States of America is one of the only countries that in the 20th century did not suffer from insane hyperinflation. It's one of only 5 countries to not suffer from major inflation crisis. So we might be heading into its first time, but we'll have to see, right? We'll have to see, and this will all be played out with China. This is the rising power in the world, as opposed to the established power. So this is really the main theme for the next decade.
So you mentioned wages and how they're being raised right now. Isn't this just a Band-Aid fix? Because we've seen this in the past where, okay, we have to raise everyone's minimum wage and then prices go up. And then the minimum wage really doesn't mean that much because prices had to go up, which means that it costs more to buy the same exact product. And it just feels like we're in this ridiculous cycle that never ends. I mean, if we went ahead and we got rid of the Fed, the central bank, and their system with borrowing money, wouldn't we end all this? Or if we went back to the gold standard, wouldn't we end all this? Because right now we're really in a central banking, currency system. And it feels like we're just continually doing the same thing over and over and over again. I think it might be time that we break free of all of this so we can stop this, because do you see the cycle just continually repeating itself?
So it's a very good question. And the fact of the matter is that it's going to be very hard for governments to go back to a gold standard, even if they want to. It's going to take a huge financial reset, a loss of all trust for the political, for politicians to even consider this. It's going to be a whole new era of politics. These are not going to be the same regular faces that you know. If this happens, if financial reset happens, it's the birth of a new power structure in the world. It's everything. So, it's hard to really forecast these changes. But we are at the very late cycles of a 80-year debt cycle that started in 1944, right after the Second World War. So we are in a very unique situation where many things are converging. The retirement wave of the baby boomers, which is the wealthiest generation to ever live on this planet, and they're estimated to hold about half of the world's cash. So they're retiring, and their consumption levels are going down. So with the United States being 72% determined on consumption, it's a consumption-based economy, a service-based economy. When you have a quarter of the country, about 80 million people, retiring at the same time as the younger generation, the millennials, which are about 80 million people strong as well. So they're another quarter of the economy going into the jobs market right now and just starting their careers. They don't have their own homes. Many of them don't have a vehicle, etc. But they are plugged with huge debts, huge student debts. That is a huge problem for the economy, because when one generation is liquidating its stocks portfolio and its real estate portfolio, and you have the other big generation, the millennials, that cannot apply for mortgages and they don't have portfolios for stocks, you're going to have a real bad situation on your hands. And that is one of the reasons, why I have about 5% of my net worth in physical precious metals, and why I'm starting to going back into speculating on gold and silver stocks, because the backdrop is just phenomenal. It couldn't get any better. In fact, if you go to wealthresearchgroup.com/gold playbook, you're going to see the most detailed and in-depth review of all the gold investments that a person can have. And, I've studied them all in the past 12 years since I started investing in precious metals. So this is going to be a huge shift. And demographically, with the United States being one of the top 5 countries in the world in terms of size, when you have one generation that's retiring, that's the wealthiest cash generation ever, and you have a new generation that is already plugged with trillions of dollars of revolving credit card debt and student debts that it can't apply for mortgages that easily, or for auto loans, for anything. That's a huge problem for the economy. It really slows it down. And until all these things are resolved, this is going to really put a lid on how much growth the United States can have. And obviously, when the United States sneezes, the rest of the world gets sick. So we are going into a very important part of this cycle, where expansion happened for 10 years. And now we're going to slow down. And if we're going to hit a worldwide recession, you can really rest assured that precious metals are going to be one of the best places to be at.
If we're talking about, a worldwide recession, and precious metals is a great place to be, why would people look at the central bank currency then? Because this brings me back to my original point. I mean, I said 1900, but even if gold moves up slowly, 1300, 1350, won't people start to catch on that there's something wrong with the central bank system? Because, like you said, there's a huge amount of global debt. The next generation, they just have so much debt they can't even function. This is just going to get worse.
Sure. And I'm sorry.
No, go ahead.
What I'm saying is, not only the big problem for the younger generation is that they're not financially educated at all. They haven't lived through any period of a gold standard. They don't even know that there's a connection between fiat currencies and gold. So, it goes back to 100 years ago when one of the early Keynesians, or even Keynes himself, said that the best way to steal from a country is to inflate its currency, because no one would be the wiser. When you have a situation where you have $100 bill in your pocket, and 5 years later it's still in your pocket and it's still $100 bill, if you don't understand inflation and purchasing power, then you think that you haven't lost a cent. But in the meantime, if the dollar goes down at about a 1.5% to 2% clip every year for 100 years, it's down 98% in purchasing power since the Fed has been incepted. So this is a real big problem. And I think a part of the world will be educated to it and will take precautions. But like any other crisis in history, most people will not be prepared. It's just it's a fact of life, right? Right.
So where do you think we're headed in this 2019 moving into 2020? What do you think? How do you think this is all going to play out?
The most important thing is what's going to happen between the United States and China. If there's a resolution and there's a tension relief, then we're going to see a last hurrah for the stock market. You're going to see everyone participating. It's going to be really the mania, right? 2017 was a mini mania, right? You saw so many people on the sidelines, so much cash on the sidelines. You didn't see mom and pop getting involved. And therefore, if you see a real resolution between the United States and China, and Trump has all the incentives to find a solution going into his next election cycle, you're going to see a last hurrah from the stock market, and then you're going to see your beautiful bubble burst. So that's if China and the United States do find ways to sit down and ink an agreement. If they don't, you're just going to see a lot of volatility, not a lot of price appreciation, higher commodity prices, and basically alternative investments winning against traditional investments, a weaker dollar, problems with the Fed. Who knows? Calls for impeachment. You're going to see just a very volatile year if this administration doesn't find a solution to its most pressing problems, which is that the stock market is heading into or just touching bear market, and that China and the United States cannot come to a conclusion. And obviously, the fact that China just had the worst stock market of 2018 of any developed nation, and in Europe you're back to bear market, valuations. This is just it's just nasty, and if there's no solution, it's going to be a really big problem. And this is what will determine 2019.
Lior, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
Our highest priority, top-ranked ideas are always going to be on the newsletter, because that's the best way to communicate to our subscribers. It's obviously free, and the reason that I found the Wealth Research Group is just because I think there's just an epidemic of financial education and misinformation in the media. There's just no way to get good information from the mainstream media. They're always the contrarian indicator. Whatever they say is the opposite or just too late. And I just felt like it's time to make sure that people have a way to know exactly what's going on and how to prepare, how to educate, and just build your base, your core, your fundamentals every single day with more information. And obviously, I'm an avid reader. If you want to check out the books that I'm personally reading, if you go to wealthresearchgroup.com/rich books, that's actually the list of books that I periodically read. The books don't change, but I change. And so I read them habitually every quarter to make sure that I always am as sharp as I can be, because there are no free lunches.
Lior, once again, thank you very much for being on the X22 Report Spotlight. I really appreciate it.
Thank you, sir.